Hello, everyone, and welcome to the Nasdaq Dorsey Wright podcast for the week ending on Friday, December 9th. My name is Ian Saunders, and we are joined as well this week by David Clark. David, it's good to have you back in here in person doing this.
Pleasure as always. I'm normally doing these over video, but every once in a while I get to pop in and show my face.
There we go. Yeah, we're more than happy to have you back here. So it is been an interesting week, certainly from a market perspective. An interesting week in a lot of the different indicators that we have available on the Dorsey Wright platform. So we can just go ahead and kind of dive into things. I think, David, the most prevalent thing throughout the research over the past week has just been changes, really a lot of changes in that broader DALI ranking, that dynamic asset level investing tool. So for those who might not be as familiar, that tool is serves a variety of purposes, but it's looking at a broader relative strength comparison of first asset classes on the top level, and then looking at different breakdowns within each asset class kind of underneath the hood. But on that top level, we've seen quite a few changes over the course of the past week. One of the more consistent things has been cash is still ranked number one, and fixed income and currencies are still ranked down at the other end at the fifth and sixth positions, respectively. Other than that, though, certainly seen a lot of changes in the middle there. We saw international equity show a lot of improvement, and commodities has been that big area of weakness, right?
Well, and that's the surprising thing right now, because that's been the asset class where it has shown some resiliency at times to ultimately carry that baton back for its leadership as far as being the leading asset class for much of the year. But this time has transpired a little bit different. We've really seen it hemorrhage an immense amount of signals and fall down to that fourth position for the first time since 2020.
Wow.
We really haven't seen it give signals up like this in really since that time. I mean, it's showing weakness that it's not exhibited in 2+ years, really.
Yeah.
Then from there, you're seeing international equities and domestic equities kind of pick up the signals and just grabbing them as they go. But the primary area where we've seen breakdowns within commodities has been energy, which is just as shocking as seeing commodities sitting in that fourth position. The fact that energy seems to be giving up its relative strength, really. And really, it's almost as if it's sort of petering out in that last leg of the race now.
Yeah. I mean, you're talking about like commodities losing 24 signals over the past, just really over the past
3 days.
3 days. Lost a total of 67 signals in the fourth quarter so far. Since the end of September, lost 67 signals, RS buy signals down to that tally count at 174, 20 less than domestic equities in that third position. And I think I was talking with Steve Raymond about this actually a few weeks ago, and one of his comments came to mind is that commodities moved up these rankings pretty quickly, right? And it has a tendency to do the exact same thing on the other end. And we've certainly seen that reflected with this, just as you said, hemorrhaging drop. And crude oil, I mean, looking at that chart this is a chart that we touched on in last week's podcast. And I kind of like to look at that 2-point per box size chart, which has just continued to drop. I mean, we're looking down at 3 consecutive sell signals on that 2-point chart, dropping down to a chart level at 172. I mean, you're seeing next real solid support level on this little bit longer term chart is in the mid 60s, at that kind of 64, 62 point, not really too much support that we're seeing in there, but it hasn't only been crude. It's been in that broader energy space as you're hitting on, right?
Well, and that's where when we look at something like a representative such as DBE, the Invesco DB Energy Fund, DBE, sorry, it's shown that similar deterioration. Maybe not quite as much chart action as crude as that
similar looking
slash, but yeah, somewhat similar. You've seen it now. DBE gave 2 consecutive sell signals, take out its September low as well as a pullback low there in March. And really, you've got support at 21 and then the bullish support line there at 1975.
That's a solid stem.
And it's not like there's much support after that either. So, it really is. I've had some conversations this week of folks looking at these breakdowns and this energy exposure with commodities weakening and saying, you know what, I'm at least lightening up a little bit on my commodity exposure. I'm going to hold it through the end of the year, but I'm lightening up a little bit to get some of these profits that they've gotten for the year. But really, that relative picture, we've seen commodities give sell signals and energy even give consecutive sell signals, but we hadn't seen that relative picture follow through yet to the extent where energy commodities were showing weakness relative to other asset classes, which we're now getting. And that's why we've seen this big change in a lot of the commodities asset class giving up those signals, because now you have the likes of DBE versus EEM, against emerging markets. that moved to an RS sell signal favoring EEM for the first time in 2 years. So similarly, DBE versus AGG, your two weaker asset class proxies with emerging markets and fixed income right now. Recently, DBE moved to a sell signal against those and had been on a buy signal either since very early 2021 or late 2020 in many of these cases. So against these major asset class proxies, you're now seeing the relative story weaken on the longer term basis too, which we hadn't gotten.
Right. And I think an important thing to note too is that you mentioned, you're talking about people potentially kind of lightening up. The asset class picture from a relative strength perspective would certainly dictate kind of moving away from commodities. DBE is still up over 25% on a year-to-date basis. There's probably a lot of other areas in portfolios for those listening that are not up 25%, maybe down 25%.
Exactly.
So if you're looking for some kind of like tax loss harvest, you could kind of moving out of some of this energy exposure and then taking the advantage of maybe moving into some other areas as we start off the beginning of next year could certainly be a prudent route to kind of look toward.
Well, and there's a lot of options that we could get into, especially just having that gain available, that can offset losses elsewhere, but we could get into a whole tax conversation about that.
Yeah,
it's not that time of year.
We won't do that for this.
Not that time of year, yeah.
But what I think we can do is take, you mentioned that relationship between DBE and EEM. That EEM has certainly been a laggard throughout the year, but we've seen a lot of improvement from some of those international areas. I think in particular on the Dolly rankings, international has picked up 10 signals since the end of November, which is good, not shocking by any means. But what is shocking is the 72 signals that it's gained since the end of September. Just in the fourth quarter alone, 72 signal pickup in that second position, overtaking domestic equities for the first time since 2010. Real notable sharp improvement from a relative perspective, at least for the broader international equity space.
And then just on an absolute perspective, we're finally seeing EEM and even EFA show that follow through to the upside. Yeah, they're moving into overbought territory right now, but that in a way is almost okay because it's kind of given us the time to catch our breath, really, if you will.
Yeah.
Because potentially trying to make especially asset class shifts right now is, in what we're moving towards the end of the year can be a bit of a challenge, if you will. But looking at a lot of these, we're seeing positive things that really haven't happened. Similarly to what we were talking about in DBE, we're finally seeing negative things there. We're seeing positive things happen within that international space that's not transpired in a year and a half, 2 years. So really at this point,
really 10 years.
And in some cases 10 years. Yeah. So, looking at a lot of that, it's almost focusing on where are we then looking to next as this holds? Right now, we're talking about a lot of broad exposure, but under the hood, it's not like there hasn't been exposure elsewhere. Because one of the places that was interesting as far as under the hood, it's been fairly quiet this year because there's been so many geopolitical tensions. So maybe not quiet per se is the right word, but Europe is one where we've seen near-term improvement out of. That really you hadn't heard many conversations out of.
Certainly not what are the positive conversation. Right. A lot of it's been, potential weakness, energy questions as we're heading into the winter months. Hasn't been the kind of the extreme winter that some might thought that might cause some more concerns in the European equity space. But in looking at the broader European equities, iShares Europe ETF ticker IEV, a solid 3.17 fund score, not as high as other areas, but a favorable. It's north of that 3.0 score line with a 2.86 direction. So it's risen from near zero level. Just looking at that default chart there for IEV, 2 consecutive buy signals, a rapid ascent from that chart low or multi-year low at that $37 mark to a current chart level of 47. So you've blown through overhead resistance from September, blown through overhead resistance from August at 45, looking towards next potential resistance up around that 49-ish, 48, 59, 49-ish point. But like you said, we're pretty heavily overbought, north of 90% overbought for European equities. And that's a consistent theme across many international equity areas in general. We've seen a solid run. We would expect some kind of consolidation or maybe potential normalization given this extended run, but just if we see some normalization, doesn't necessarily mean it's going to turn around and go back lower, right?
Right, exactly. Well, and even as we're talking about normalization, for prices, we're also still dealing with relative price movement as well. So we could see normal prices for a lot of these, European or international equity representatives, but you could still get changing relative relationships in that process as well.
Certainly.
I mean,
Yeah.
and it was interesting because as you were talking about IEV, I pulled up that market RS chart of IEV versus SPXEWI, and it's within a box of reversing back into X's for the first time since May. Well, no, depending on how, looking at the chart here, technically since June of 17.
Wow.
It's been in a column of O's.
Okay.
So, June of 17, and it would be the first time in a column of X's since May of 17.
Yeah, and we'll throw this chart up on the podcast for those that are just listening. Certainly can throw it up there.
Was interesting little tidbit looking there as I looked at the RS calculation. I'm like, wow, that's a lot closer than I would have expected it to be to a potential reversal.
Now, certainly
not going to change the long term picture right now because that potential RS buy signal was way far off, but. It's at least an indication from near term basis and at least some indication from some other basis that you're also, and potentially confirmation really, that you're seeing relative gain versus, in this case, the domestic equity index that really hasn't shown that type of gain in roughly 5 years or more.
So, and I mean, it's not just the Europe space. I mean, now looking at like the United Kingdom too. I mean, it's in the Europe area, but no longer part of the Eurozone, obviously. But like the iShares UK ETF, ticker EWU, similar kind of picture. I mean, just sharp movement higher, but pretty heavily overbought territory that you can see there. So it's just been kind of across the board within that Europe space. Seen some improvement, seen some real sharp improvement, specifically relative strength improvement. But maybe kind of wait for some consolidation or a pullback before looking to jump into exposure there. I mean, another area we've talked about a lot throughout the year, and as we kind of try to bring the conversation here to a close, we can't end the conversation around international equities without touching on China, though. So talking about an area that has seen sharp absolute improvement, but really not much relative strength improvement, right? I mean, in looking at the broader Nasdaq or NDW country index matrix rankings that we have, China and Hong Kong still ranked down in the bottom couple spots within that out of the 42 member matrix that is taking a look at. Many European equities kind of ranking up the top end, but China continues to rank very low. But we've still seen areas that have shown improvement. I mean, one that comes to mind is like the CraneShare CSI China Internet ETF, ticker KWEB, KWEB. 3.23 fund score, shown a couple consecutive buy signals, actually given a second consecutive buy signal today. Real sharp improvement, but we just haven't seen that translate over the relative strength picture yet.
Not yet. And I mean, it's also been like as soon as with China this year, as soon as you've seen enough improvement or some crazy absolute rise, it's almost been the point which is getting ready to turn. So,
right.
And it's just been a challenge one after another with China here recently. But it's also seeing this international equity space improve. You can't not at least kind of have it in the back of your mind.
It would be hard to imagine that you would see the broader international space improve so much. And not have what's 30% of EEM is looking at China, almost 30 to 40%, and not see that improvement kind of carry over. So we're starting to see some improvement there. We're seeing relative strength improvement in looking at China representatives compared against like kind of China defensive or Chinese fixed income. We're seeing that improvement, but we're just not seeing the China improvement compared against other areas in international equities, really, because everything's kind of been marching higher as we're touching on. So it's hard to get that dispersion.
It's almost like China's trying to catch up,
which is
this way.
Typically not the case.
Which is typically not the case. And really, it's oftentimes when we're talking about international equity rallies, it's China that's leading the way.
Right. Or at least it has been the past few years.
Right. And now that story is changing.
Yeah, and there's a lot of other potential concerns or questions going on with the broader geopolitical realm with China.
That could be a total separate podcast.
Could be a total separate podcast and something that we're certainly not as well versed to discuss there. But I mean, it'll certainly be interesting as we see some of that play out or some of those developments occur as we look toward the beginning of next year and how that plays out into the equity space too. I mean, as we saw all these kind of news headlines and stuff, I mean, at the end of the day, all filters down to price movement, right? We're seeing that price movement improve. Just would like to see a little bit more consistent improvement as we look toward next year.
Right. And at this point, hoping to see cash start to give up some signals in dollar.
Yeah, that'll be the other thing that we'll be looking
term piece.
Right. Yeah. So as we kind of I think we kind of bring things to a close here with that. I mean, it's in things that we're going to continue to take a look at. Obviously, we'll continue to can keep you updated either through the report or through media like this podcast with any other kind of changes that we see within the Dolly rankings. We still see that international and domestic equities, even though international second, domestic equities is third, they're pretty close from a signal perspective still. That's a relationship that we're definitely continuing to monitor as we wrap up 2022 and look toward 2023. So with that, David, thank you for coming in, joining us here in person.
Pleasure as always.
And thank you very much to everyone for tuning in this week, and we'll be back to talk to you again next week.